Hello, I want to talk a little bit more about private credit and developments in the availability of private credit and private equity to retail investors. This is a follow-up on the more detailed article I wrote in my June 2025 deep dive. I ended that article by saying if there were developments I would comment further on it. Indeed, there are developments. This presentation will be in three further parts. Firstly, explaining what the developments are, and secondly, asking if what we now know matters to us as UK retail investors, and finally, looking at the timescale for any possible changes and the potential reaction, likely actions by the UK regulators. So what's new? Here I'm going to quote a bit from a useful article published in one of the New York Times' daily newsletters written by somebody called Danielle Kay. As an introduction, I'll read what she writes. The private equity industry, facing a slowdown in exits and fizzling returns, has long coveted a $12.2 trillion pool of money, retirement savings. Now it is one step closer to managing some of the funds in America's 401ks and related plans. President Trump signed an executive order on Thursday, that's Thursday last week, that clears a path for plan managers to add private equity and other alternative assets to retirement savings accounts. Other alternative assets, interestingly, include some cryptocurrency assets. This is said, and I'm quoting again, to mark a notable shift. Private market investments, while not technically barred from 401k plans, are riskier than publicly traded stocks and bonds. They have traditionally been seen as unfit for defined contribution plans. Now, I explained something of the details of why private equity and private credit are more risky and why perhaps private investors are not likely to be, or retail investors are not likely to be interested in those assets from the off in the more detailed article. So if you didn't read that, I recommend you do so now, or if you've forgotten it, ditto, go back and have another read. Trump isn't actually giving instructions by his highly democratic rule of the king executive order, but he's asking the Labour Department, which I suppose is the equivalent of the UK Department of Work and Pensions, to re-evaluate its fiduciary guidelines, which I think, bearing in mind the amount of lobbying that's going on, means to relax the fiduciary guidelines and permit those wealthy people who have a lot of money tied up in private equity at valuations that are not justified, so they've got no further potential profits and with no liquidity, to essentially dump their assets on the naive retail investor who, having seen or heard or even having misrepresented to themselves the idea that private equity is a great way of making loads of money very fast, assume that that's going to happen again, whereas in fact the opposite is likely to happen. Now, you can tell I'm pretty negative about this as an investment opportunity. It may well have value, but it's going to take a great deal of time and the proper regulations before we in the UK can invest safely in this asset class. So why does it matter? If I'm saying, well, you don't want to invest in this asset class, this is all a scam, that's all you need to know, isn't it? No, it matters for another reason. There's a very, very large amount of money invested in private assets. The intention is to persuade retail investors, initially in the United States, and that's where most of the retail investment money is, to invest into those private assets, effectively buying them from the existing holders, mostly wealthy individuals, hedge funds, private equity funds, family offices, and so on. Now, if new buyers are going to purchase those assets, they're going to have to do so with cash. Where's that cash going to come from? Well, it's either going to come from the cash flows the savings going into retirement plans, in which case it's not going to go into the public market, or it's going to come by selling public market assets. The impact of both those potential sources is exactly the same. Less demand for public market assets. Remember that a huge proportion of growth in the global stock market, as represented by, say, the MSCI Global Index, or indeed many people's portfolios, has come from listed companies in the US. In fact, most of it's come from only 7 or 8 listed companies in the US. If money stops flowing into those shares, you can tell what will happen to the price. So, introduction of a new supply of assets to the US retail investor will undoubtedly impact demand for existing assets. Furthermore, should this all blow up a little way down the track in the way I speculate it might, that systemic crisis could be as dramatic as the financial crisis of 2008, and that would have an implication for all assets. So generally speaking, we need to pay attention to this because it's a potential headwind for markets. It's even a potential further flamingo, to use my previous example, a white flamingo, different to the average, and one of the several, I think I already mentioned 3, this is a 4th, really big hints that things could be cooking up rather badly for equity markets across the globe. What about timescale? Well, Trump's given this order, the regulators will have to think about it, and the detail will emerge, I think, over the next year or 2. On the other hand, Morningstar are already beginning to offer webinars for professionals on how to deal with various aspects of this change in the market. So it's not that far away. In the UK, could be further away. The UK tends to follow the US. When I was young, I used to reckon that it took about 15 years before something happened in the UK that had happened in the US. Usually the Americans have proved that the idea was a complete disaster by the time the UK copied it. Things like SATs as education tests, for example. But I think the internet, changes in globalization and so on means that time scale is significantly compressed, and in the service industries, to be honest, it's generally fairly easy to copy ideas from one developed country to another developed country. So it might be that the UK regulator starts looking at this now and possibly introduces some rules in the next 3 or 4 years. They have already introduced an asset class called long-term asset funds, which I've mentioned in past commentaries. They're not available to retail investors directly, but they are available to institutional funds. So indirectly, they might already be something that people have got unknowingly in their portfolios. Long-term in the UK means assets where the investor can't demand their money back, as you can with most collectives, overnight. You have to give notice, possibly as long as 6 months, because the style of the investment is such that the manager wants to have no interference from demands for liquidity. Obvious examples might be investments in commercial properties, for example, but things like research and development funds occur to me. So don't think that this isn't going to happen in the UK, or that it's going to be a really long time away. There will be a massive irony, though, I have to point out, because only last week the regulator, after years of deliberating, fined the now notorious Neil Woodford something in excess of £70 million, that's his business, and him personally some more money, and banned him from various financial services jobs on the basis that he failed to manage the liquidity of his fund. Now, the way in which he failed to manage the liquidity of his fund was effectively buying something very close to private equity. In some cases, he probably did buy equity that wasn't traded on a recognised stock market, but in a lot of cases, he was buying equity that was theoretically tradable, but where the market was so small or had so little liquidity, effectively the assets couldn't be realised. And some of you listening to this have still got money in Woodford funds that you haven't been paying back because no liquidity has become available in a trivial rump element of the Woodford fund. So regulators at the moment say, oh, naughty boy, shouldn't be buying illiquid private equity assets. Serious punishments will follow if you do. Whereas in America they're saying, Retail investors need access to this asset class. It's going to make them lots of money. It's wonderful. That's the way the world is. On that note, I will leave you to ponder and promise to update you further as is necessary.